Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is our 86th episode, COVID Crash FAQs. COVID-19, isn't it, Cory?
It is.
Yeah, it's a horrible pandemic. We've been getting a lot of questions from clients. We've been having a lot of outbound calls to clients. And so we wanted to take this opportunity of our 86th episode of Upticks to answer some frequently asked questions that you may be thinking and haven't had the chance to ask anybody yet. These are all going to be pertaining to, of course, your financial plan or investments. We have no idea when the pandemic will end, and we're not going to try to claim that we do. It's horrible, but we know that this too will pass. We've been through horrible events before. It's just part of being human or living on Earth, and these types of events happen. And this is, frankly, Cory, why you and I have jobs. And this is what we're here to do. As of the recording of this episode, the market's down, or the S&P's down around 28% or so from its all-time highs. Like I said, we don't know when the end will happen, but we do have some answers to some frequently asked questions. So Cory, why don't you kick them off? We've got a few questions, and then I wanted to talk about some things that people should be thinking about in different, basically, places in their investing lives. So go ahead.
All right, first question I've got for you.
Let's hear it.
How does my financial plan take a 35% decline into consideration when it shows the same return every year?
That's a really, really good one. It's frequently asked. Do you think it is?
FAQ.
All right, so some of you may be asking, okay, Jake, Cory, we've got a 6, 7, 8% projected rate of return. We don't have a negative 20% year. Well, in reality, you actually do, because with our financial plans, the target rates of returns do have market corrections of this magnitude in the averages. So while we certainly don't know when they'll happen, we know that they do happen. Just like years in 2019 happened, where the stock market was up all around 30%. So the idea is that our averages, they do know that we're going to have market corrections of this magnitude, and so they're already in the plan.
Okay.
Question answered. We've got that factored in.
All right, next. You're telling me that you think, let me start over. My next question would be, if you say that you think stocks, things might get worse before they get better, right? Why don't you just get out of stocks now if you think they're going to get worse?
Yeah, that's a good one. That's very common. So we've had a lot of conversations here lately with clients saying, get me out. When the market goes back down, then I'll buy back in. It's a very, very dangerous game out there. And I saw actually one of the big advisors in Kansas City, Peter Maluk, had a good quote out there. He works with creative planning. And he said that in his 20-year career, he's never seen somebody time it right, basically is what he was getting at. And so it's a fool's game. You have to know when, at what price to sell your stocks, and at what price precisely to buy them back. I guess theoretically, as long as you bought them back lower, but you're going to always be playing this guessing game. The main thing that clients want to remember is that your stocks should be in your portfolio as a long-term investment.
Yes.
Your stocks should not be comprised of capital that you will need to access within the next 5 years, preferably 10. Our clients usually fall somewhere in between 5 and 10 years. So the point is, if you know you're not going to need this asset for a minimum 5 years, frankly, it doesn't matter what the value of that asset is today. And it doesn't matter if you flip it and you try to sell and buy it. As long as it's higher 5, 10 years from now, that's really what we're banking on, is a long-term growth. So you want to be very careful with that. It's a fool's game. You can't time the market. It's very risky. Another one of our colleagues out at Hightower, David Bonson, had a good quote up there. He was saying how a 3-week time frame in the market never ruined a 30-year retirement time span, and it won't yours. That's something that he said, which I find a lot of truth in. So a few months even is not going to blow up a 30-year financial plan. So don't try to risk it. Don't gamble your retirement. You shouldn't do that.
And I think, just to quickly add to that, getting out of the market's probably the easy part, like you're saying, getting back in, because it either continues to decline further and you want to wait until you feel like it's got to the bottom, which no one knows, or it snaps back and it starts going up, and then you say, well, I'm going to wait until it falls again. And what if it doesn't?
Right. Very, very dangerous. Yep, you're gambling. And we invest money, we don't gamble it.
Yes.
And there certainly shouldn't be gambling your retirement.
Yes. All right, good. Lastly, how quickly do you think that the market will return to the previous all-time highs?
Yeah, I don't know. I mean, I've got a good chart that we will flash up on the screen here. Basically what it does is it has the averages and the median time frames. You can see from the chart that the typical median, because again, the Great Depression skews everything on this chart. So the median or the middle is around 2 years, roughly, to get back in, or back to where we were, excuse me. Not back in, you stay in the whole time.
Correct.
So the normal time frame is 2 years, just to answer that question. I have no idea how long it could take. The last one took closer to 5 or 6 years, back in 2007, 2008, for the market to get back up to where it was. I have a feeling that since this one was so abrupt, that we have potential for it to abruptly go back up. But again, I don't know. Again, for my clients, they have 5 to 10 years to wait it out. They're living off their bonds in the short term. So I don't know. No, and anyone that tells you they know, again, I'd be wary of that person because you're predicting the future. Nobody knows how long. 3 things need to happen though for this thing to end. I'll tell you real quick. One is obviously we need to get a flattening of the curve. So we need to get less outbreaks or for that to start stabilizing or leveling off. 2, I would love to see oil prices stabilize. You know, the Saudis and the Russians have really driven the price of oil down. I would love for that price of oil to go back up, a little bit at least. And then 3 is that we obviously need the Fed or the government, and by the time of this being pushed out, I'm sure something would have already been passed. So we need to continue to get support from the Fed and the House and the Senate and the President to help prop up small businesses and make sure that the economy still keeps going during this time. So those are the 3 things that I'm looking for. I would say once we have those 3 things in check, you should expect something to start to recover. Again, unless something else comes out of left field that we don't know about.
Okay.
Good. Thank you for asking those questions.
You got it.
And thank you all, as always, for tuning in. I did have one other segment that I wanted to talk about real quick about this. Is another frequently asked question is, one, there's basically 3 different phases of your retirement life cycle. One is in retirement, right?
Okay.
One is right before you retire, and then one is the early years as you're saving for retirement. Excuse me. So I wanted to talk about what each set of categories should be thinking of right now. So real quick, so you're retired, right? Jake, I retired, the market's down almost 30%. What am I supposed to think? Again, I've already alluded to that. You should be thinking, do I have enough money in bonds? Am I getting Social Security? Am I getting a pension? Are those numbers still healthy? And then you even alluded to this a little bit also. You should be revisiting your financial plan, not worried about the value of your account. The most important thing during these types of markets is your financial plan. It's really more important. So 1, revisit your plan. Make sure you have an adequate amount of money in bonds or cash to weather the storm. What about somebody, I'll let you answer the second one, the middle one here. What about somebody, whether it be 3 months from retirement or 3 years? What do you say to that person? Should they still retire?
Well, like I said, it depends upon their plan, but assuming that, we've done the work and they've done the work to kind of crunch all the numbers and actually look, try to get a good feeling of what their next 30 years are going to look like, 3 weeks shouldn't make that big of a difference.
Yeah, and it all comes back to those bonds. I can't say that enough.
Yes.
I had a really good conversation with a client today who's very close to retiring. And, he may decide to work a few more months to let the waters calm a little bit. He made a good comment. It's not like he can go anywhere right now.
Right.
I mean, if your plan is to retire and travel, you're going to travel next month.
Not a lot to do, right?
Yeah, you can't go anywhere. So why don't you keep working and collect a paycheck? But also, I confirmed his points. Like, we got to make sure we got enough money in bonds. And you know what the reality is? If you're going to retire in the next few years, you're also going to have markets like this when you're retired.
Yes.
Like what you were getting at. So,
yep.
Again, but we never want to encourage somebody to retire, right? If you're not comfortable and you want to work 3 or 6 more months, it's more than likely going to make your plan look better. So it's not necessarily a horrible thing. But again, go back to the financial plan, crunch the numbers. Let's see what it looks like.
Yeah, and once you've confirmed that financially you can do it, then ultimately it's up to you to decide when you're ready to go. And if you say, you know what, and in the midst of everything that's happened here, I think I'd rather work another 6 months. I don't hate my job. I don't mind doing it. Nothing wrong with that.
There's nothing wrong with that at all. Again, it's more of an emotional and financial decision. You got to have both of those in order.
Yep.
And Then the last point I wanted to make is the people that are, let's say, over 5 years from retirement. Okay, so maybe you're in your early 50s, 40s, 30s, 20s. You should be jumping all over this opportunity. You're not going to get prices this low probably for quite some time. I don't know, again, but it's a very easy time to go out there and pick up shares very inexpensively. And so we would be encouraging you to ramp up your 401k contributions as long as you have the appropriate amount in emergency savings, right? So you want to be very careful with that, because there might be some companies going out of business. So you want to make sure that if you're in one of those high risk jobs that you could lose your job, that you've got a cash cushion. So I'm not saying take away your emergency savings and throw it into the market. But if you're already saving in your 401k and you already have that emergency savings, let's ramp up those contributions. Let's buy more. Let's fund a Roth IRA. It's not too late to fund a Roth IRA for 2019. Let's do some of those things, get that money working for you. Take this as an opportunity to get some movement and do the things that you've been wanting to do financially. But do not go out there and sell your house and put that money in the stock market. Don't go take a second mortgage out. Don't go take a loan out. I'm not saying that you should get crazy aggressive here. I'm saying if you had intentions to ramp up your savings in the retirement section, now would be the time to do it.
Yes, that's good.
Right? Good. So again, these are FAQs. We're going to be rolling out more of these episodes as we go. We don't want to keep them too long. We hope everybody out there is staying healthy. I need a haircut. You need a haircut yet?
I'm getting close.
Barber's closed, and I think it's going to be closed for probably a month.
I think so.
So I don't know what's going to go on. Cory and I are holding down the fort at Falcon Wealth Advisors. Our team is working remotely, so you all have access to us as always. Please, like I said, stay healthy. If you're out there, I know you're probably out there on social media, so thank you so much for following us on Facebook, Instagram, Twitter. If you're watching this on YouTube, we really appreciate it. If you're listening to it on your favorite podcast platform, thank you very much. Our subscriber base is growing, and we really appreciate it, and we really enjoy helping people and pushing out more content. Anything else?
Nope. The only thing I'd add to that is, given these times where people have a little bit more extra time, we also love getting feedback and getting questions that people are wondering about that maybe if somebody hasn't asked me directly or you directly, but it's something that's on your mind, I'm sure somebody else has the same question or concern. Let us know. We can talk about it.
Perfect. Thank you, Cory, and thank you all for tuning in. We hope you have a great week.